When deciding to purchase a home, one of the biggest questions you'll face is which loan type to choose. In the world of home loans, there are three main types to consider: FHA loans, conventional loans, and VA loans. Each loan type has unique features, including down payments, interest rates, private mortgage insurance (PMI), and other associated fees. Understanding how these loans differ and which one best suits your financial situation can make all the difference in your monthly payment. Let's dive into the details of each loan type and look at what you can expect when it comes to true monthly payments. FHA loan. First, let's take a look at the Federal Housing Administration loan, commonly known as an FHA loan. FHA loans are ideal for those with less than perfect credit and who may not have the 20 down payment required for conventional loans. One of the major benefits of an FHA loan is that it allows for lower down payment, often as low as 3.5. However, one of the key factors to consider with an FHA loan is the private mortgage insurance, or PMI. Unlike conventional loans, where PMI is required only if the down payment is below 20, FHA loans require PMI for the life of the loan, unless you put down 10 or more. This could add to your monthly payment, so it's important to factor this into your budget when considering an FHA loan. Additionally, FHA loans come with fixed interest rates, which can be beneficial for long-term budgeting. The mortgage insurance premiums, which are paid monthly, can be a significant portion of your payment. When evaluating FHA loans, it's crucial to calculate not just the loan principal and interest, but also the impact of PMI, which could affect your affordability in the long run. Conventional loan. Next, we have conventional loans. Conventional loans are typically issued by private lenders and are not backed by the government. These loans are often seen as the gold standard for home financing, especially for borrowers with good credit and a stable financial background. Conventional loans come with the option of both fixed and adjustable rate mortgages, giving borrowers flexibility depending on their financial goals. When it comes to down payments, conventional loans typically require a higher amount upfront than FHA loans. A standard down payment is 20, although there are some programs that allow you to put down as little as 3. However, keep in mind that if your down payment is below 20, you will be required to pay PMI. This PMI can be removed once you've built 20 equity in your home. The monthly payment for a conventional loan is influenced by factors like the loan amount, the interest rate, and PMI if applicable. But compared to an FHA loan, PMI on a conventional loan can often be less expensive, especially if you have a higher credit score or a larger down payment. So while the upfront cost may be higher, a conventional loan can save you money over time, especially with the ability to remove PMI once you reach a certain equity threshold. VA loan. Finally, let's discuss VA loans. VA loans are specifically designed for veterans, active duty service members, and sometimes their families. One of the most attractive features of a VA loan is that it requires no down payment, which can be a huge advantage for eligible borrowers who may not have substantial savings for a down payment. Additionally, VA loans do not require PMI, which is a significant cost-saving benefit. However, there is a funding fee associated with VA loans, which is a one-time fee that helps to offset the cost of the program for taxpayers. The fee can vary depending on the type of service and whether you're a first-time or subsequent user of the VA loan program. Although VA loans come with no PMI and no down payment requirement, it's important to consider the funding fee in your overall budget. While it may be added to the loan amount, it can still impact your monthly payment and should be factored in when deciding if a VA loan is right for you. Furthermore, VA loans typically offer competitive interest rates, making them a great option for those who qualify. Choosing the right loan. Now that we've gone over the key differences between FHA, conventional, and VA loans, the next step is to determine which one is best suited to your financial situation. If you have a lower credit score or limited savings for a down payment, an FHA loan might be the best option, despite long-term PMI costs. If you're a veteran or active duty service member, a VA loan offers significant advantages, including no down payment and no PMI, making it an appealing choice. On the other hand, if you have good credit and enough savings to make a larger down payment, a conventional loan could be a better choice due to the potential for lower overall costs, especially once PMI is removed. Remember that when considering which loan to choose, you need to look beyond just the interest rate. Consider factors like PMI, funding fees, and how each loan type impacts your monthly payment. The right loan for you will depend on your financial situation, homeownership goals, and long-term budget planning. In the end, it's essential to work with a knowledgeable mortgage professional who can help you understand the nuances of each loan type and assist you in making the best decision for your needs. By fully understanding the true costs of each loan type, you can confidently choose the one that works best for you and your future. Let's begin with FHA loans. The Federal Housing Administration loan, or FHA loan, is often the go-to choice for first-time homebuyers or those with lower credit scores. One of the primary benefits of an FHA loan is the lower down payment requirement, which can be as low as 3.5. This makes it an appealing option for those who might not have significant savings set aside for a larger down payment. However, with FHA loans comes the cost of private mortgage insurance, or PMI. Unlike conventional loans, where PMI is required only if you put down less than 20, FHA loans require PMI regardless of the down payment amount. If you make a down payment of less than 10, the PMI will be required for the life of the loan, meaning it will be part of your monthly payment for the entire duration of the loan. On the plus side, FHA loans offer fixed interest rates, making your monthly payments predictable. But when you factor in the cost of PMI and mortgage insurance premiums, your total monthly payment may be higher than expected. It's important to carefully assess your budget to ensure that the extra cost of PMI fits within your financial plan. Conventional loan. Next, let's look at conventional loans. A conventional loan is a home loan that is not backed by the government, and it's typically issued by private lenders like banks or credit unions. Conventional loans are available to borrowers with good to excellent credit and a stable financial history. One of the key advantages of a conventional loan is that you may be able to avoid PMI if you can make a down payment of at least 20. If your down payment is below 20, however, you'll be required to pay PMI until you reach 20 equity in your home. The good news is that PMI on a conventional loan can often be removed once you reach that 20 threshold, reducing your monthly payment over time. Conventional loans also offer both fixed and adjustable rate options, so you can choose a loan structure that fits your financial strategy. The interest rates on conventional loans are often competitive, especially for borrowers with higher credit scores, and the overall monthly payment could be lower than an FHA loan if you're able to avoid PMI. However, conventional loans typically require a larger down payment than FHA loans, so they may not be the best option for someone with limited savings. Despite this, the potential for lower monthly payments in the long run makes conventional loans a popular choice for many home buyers. VA loan. Now, let's talk about VA loans. VA loans are a special benefit for veterans, active duty service members, and sometimes their families. The biggest advantage of a